Hello, economic students. We're continuing our discussion of money and banking. And on page 652 of your second edition of the textbook, 652, you'll see a distinction that you should be aware of. It says, what's the difference between a bank, a savings and loan, and a credit union? Well, banks are corporations that perform the full range of banking services. Savings and loans still exist, although they don't often have the term savings and loan in the name anymore. There was a kind of a scandal where a lot of them failed back in I guess it was the late 1980s, and as a result, they made it possible for them to kind of clean up their image by losing the term savings and loan from the name. So a lot of places you see the word bank in the title, you have to look kind of deeper in the sign to see that it's actually a savings institution and not a full-service bank. But the original idea of a savings and loan was you could get a somewhat better interest rate on a home loan. The main thing they were there for was to provide home loans. But their activities have become more like a normal bank, and I don't think it's worth your time to worry too much. Odds are you're going to mostly be dealing with banks or something very, very much like a bank, or a credit union. Now, a bank is a corporation. It's got shareholders and all that, but it's a normal corporation. A credit union is an association of members, and the members are the owners of the institution, the financial institution. Now, how do you get to be a member of a credit union? Well, you have to be part of a defined group. It can't just be every human being on earth, but it has to be some definable group of people from which membership can be taken. So, for example, I am a member of the American Airlines Federal Credit Union. My dad used to fly for American, and as one of his dependents back then, they let me open up an account, and once you have an account, you keep it forever. So I've been a member for decades in the American Airlines Federal Credit Union, but it was open to American Airlines employees and their dependents. But it can be something fairly broad. Tarrant County Credit Union could be open to anyone who lives in Tarrant County, Texas, could become a member. But it can't be absolutely everybody. It has to be a defined group that you're a member of. And then you choose to become a member. You can deposit your money in checking accounts and the like, but you're also able to access loans through the credit union. And credit union loans for members are almost always a little better than a commercial bank can give you. The other perk of being a member of a credit union, it's not a huge one for most people, but you do actually get a cut. These are non-profit institutions, and if there is any money left over as profit, the money is distributed to the membership. Now, that's often based on how much money you had in your depository insurance accounts over the course of the year. And in my case, it's never all that much at any given time. So they give me like $4 a year or something at the end of the year. But I am a member, so I'm entitled to that cut. So that's a little something. But the main reason you want to be a member is you can get a better rate on loans usually by being a member of a credit union. Okay? But they don't provide the full range of services a commercial bank does. And you have to be part of that defined group in order to become a member. There are actually slightly more credit unions in the United States today than there are banks. Something like 5,900 banks and 6,700 credit unions, something like that. All right, I wanted to point that out. Now, the crucial thing, though, that you need to figure out here is the idea of a balance sheet. Now, they don't give you a big accounting lesson here, but the basic idea of a balance sheet. Balance sheets are often in the shape of a T, called a T account balance sheet. And on the left side of the T, you have assets. On the right side of the T, you have liabilities. And then you have net worth. Net worth is assets minus liabilities equals net worth. So what are the assets? Well, if you're talking about a bank, They're everything the bank owns that has value. Now, one of the things they own are loans they have made. They've loaned out money. How do you know how much those loans are worth? Well, it is how much some outside party would be willing to pay the bank to buy the loan. That means if it's a dead certain bet that the loan is going to be paid back, then the loan would be pretty much its face amount, how much dollars the loan was for that is still have to be paid. If there is some question, as there often is, whether the party will be able to perform the whole loan, you have to discount the value of the loan. People wouldn't give you the full value if there was a 20% chance they thought that the person who took out the loan would never be able to pay it all back, right? They definitely wouldn't let you sell it to them for as much. So you have to take the risk of the loan into account. If a bank has made a bunch of risky loans, their asset value is less than if they were sure thing loans, okay? But the loans a bank has outstanding are an asset. All banks have investments of their own. They often invest in the most conservative investment you can make, which is government bonds. Those have always been paid to date and hopefully always will be. They don't pay a whole lot of interest, but they are the safest. Treasury bonds are the safest investments you can get in the United States. And then reserves. Reserves are the money the bank actually has on hand. Now remember, there are reserve limits imposed by law, what banks have to have on hand, either in their store fronts or in a vault at the Federal Reserve Bank where they could get it. That's where a lot of the reserves are actually kept, the Federal Reserve Bank in Dallas in our case. But the reserves are there. Remember where the money comes from for banks to make loans. It comes from depositors. You work your job at Chick-fil-A and you deposit the money into the bank and they pay you, maybe direct deposit. You may never even see it. That money goes into XYZ Bank's checking accounts you've got opened. And then they can take a portion of the money you've put in that account and loan it out to other people at interest to make money. But the federal government puts reserve limits on telling banks you cannot loan out more than X percentage of your deposits. You've got to keep a certain amount, I think it's typically around 15% if memory serves, of that money on hand. If people want their money back on any given day, you got to be able to give it back to them. So you've got to have a certain amount of cash. So anyway, a bank's assets are the loan, the value, the present value of the loans it has outstanding, which takes into account risk, the investments they've made, mostly government securities, and the reserves they have somewhere in a vault that they could get their hands on like that. What's the main liability of the bank? The deposits of depositors. Now you might think, wait a minute, you're giving the money, how is that a liability? Because they have to be able to give it back to you. They're holding it, but they have to surrender it to you. They owe you the full amount of money in your checking account or your savings account. So it is, they owe you. They like your bank statement's like an IOU. We owe you $2,910. So it is actually on the balance sheet a liability. Okay? Now, in a perfect world, it should, all the assets and all the liabilities should equal out. If something's not equal, something's wrong. And the bank examiner is probably going to say, let's find out what that is. He wanted to balance out on both sides of the equation. All right. Now, one of the things the book does after that is talk about how do banks make money in an economy. And the way they do it is by loaning out money, which is then put in other banks. So let's say Joe Smith goes to XYZ Bank, and Smith borrows $100,000. It takes that $100,000 and puts $90,000 of it into Joe Smith Bank. And then Joe Smith Bank has $90,000 it can loan out because of the deposit, right? And so this money gets spread through the economy. It is making income for two banks who've loaned it out. And this is called the multiplier effect. And in your book, it talks about this. Let's see, where does it talk about it? It talks about it on, I guess it's talking about on page 657, the money multiplier. And it is a way you can do the calculations. You know me, I don't care about you doing the math, but I just want you to get the idea. If a bank loans you money and you take that money they loaned you and you deposit it in another bank, that means that money is now available for the other bank to loan out to someone else who might take that money and put it in another banking account so it gets loaned out. And so the original amount of money can be multiplied in the economy by this process. Okay? So the money multiplier, and it's pretty high. I want to say the money multiplier is like 30 times or something. It's a lot. It's in your textbook, but I just want you to get the general idea, okay? The other thing to talk about is, it talks about the asset liability time mismatch, and that is 655. Asset liability time mismatch. What it means there is, the asset is the loan the bank has made. The liability is the deposits that people have put in the bank. They can get that money out anytime. They can put $1,000 in the chicken they got today and come back for $999 of it tomorrow. And they have to be able to surrender it immediately. But if they've loaned that $1,000 out to somebody in the meantime, that money's going to trickle in over years, not days, not a day. So the assets of the bank only accrue over a long period of time. The liabilities are due at any time. That's the asset liability time mismatch is what causes banks to go bankrupt. And we talked about this run on the bank, right? If people deposit money in checking accounts, they want to and have the right to get it out anytime. If they think the bank is in financial trouble, if it's made a bunch of bad loans that people will not be able to pay back, then they might turn up all at once and want their money back because they're afraid it won't be there a month from now when they want it. So that's called a run on a bank. So how can banks protect themselves from this? Your book points out on page 655, they need to make sure they don't get themselves in a position where the loans they have outstanding all get in trouble at the same time. And the way you do that is by diversifying. See, think about this. If you were a bank and all of your customers were construction firms building office space in downtown Dallas, that's very risky. If something happened that made people not want to rent office space in downtown Dallas, all those loans might be very hard to get paid back, right? If the people you're loaning to don't stay in business and flourish, they may not be able to pay you back. If you put all your eggs in loans to business pavilions in downtown Dallas, you are running a huge risk. Now, could be conditions are such that you might make a lot of money on loans, but what if something goes wrong? You always have to plan what if something goes wrong. Hope for the best, plan for the worst, right? So what you should do is diversify. Spread out your loans widely, not just in one area, but in a broad area. Not just one kind of business enterprise, but in a broad area. So that's what diversification means. If the downtown Dallas office market fails, hopefully the home loans will still be coming in from San Antonio, okay, or Chicago. So you want to spread your pool of loans you've got out there as broadly as possible, so you're not at such a great risk of not getting paid back on a regular basis. Okay. The money multiplier, it cautions about that. I think that's all on that, and it's 15 minutes. So we'll continue in the next lecture with monetary policy and banking regulation. This is the Federal Reserve Board. See you soon.